Alright, in this video we're going to be going over the IRS examination and collection process. My name is Eric Ballin. I'm with the Low Income Taxpayer Clinic in Provo, Utah. And the Low Income Taxpayer Clinic, LITC, it's a nationwide program. We receive federal funds to provide free service to taxpayers who qualify for the services with resolving IRS problems, basically, IRS controversies. So for this video we're just going to be going over some of the basics of the examination, audit, and collection process, and just some of the notices that you can receive kind of in sequence, and what the taxpayer can do at every step of that process. So first, let's look at some of the notices that you can potentially receive. We have proposed deficiency notices, 90-day letters, notice of demand for payment within 60 days, request for payment, notice of lien, and then notice of intent to levy. So let's go over first the proposed deficiency notice. This is basically the beginning of the examination process of the IRS, the audit process. Audit is actually a type of examination with the IRS. And just to give you an idea of some of the different types of examinations that you can receive, you can have a dependency audit. That's where maybe if you claim a child and someone else claimed that same child in their return, they're going to be sending out a dependency audit to both of those taxpayers. And then whoever can really prove that that dependent qualifies to be their dependent will be able to maintain that dependent on their return. Also, with all of these different types of audits, the IRS doesn't necessarily need any type of red flag necessarily to trigger this audit, but there are certain things that will make the audit more likely. We also have filing status audit, like if you file for head of household, you're actually married, and then your spouse files as married, and then the IRS is going to send you an audit to resolve the matter and figure out who's actually telling the truth. Then we have expenses and deductions. Expenses like on a Schedule C, business expenses, and then deductions like itemized deductions. The IRS could question that. You have to send in documentation to prove these things you've claimed in return. And then we have underreporting. This is a really common one, and that's where you just don't report all of your income on your return that was sent to the IRS. There could be a lot of reasons why that happens. Usually it's just because the taxpayer forgets to claim some income on their return. So here's just an example of an automated underreporter notice, CP 2000 notice with the IRS. Basically they're saying, okay, here's this income that was reported to us, maybe a 1099 miscellaneous, and it wasn't reported on your return, so there's a discrepancy, and based on the new calculations that we've come up with after adding that income to your return, this is the amount that you owe us. So what you can do at this proposed deficiency stage is that you can protest the proposed deficiency. If you do that, then appeals will attempt to resolve the matter, and appeals is kind of a separate entity from the IRS, and they're set up with the purpose to provide kind of an objective viewpoint on the situation and look at the information that's provided to them from the IRS and from the taxpayer and resolve the issue and figure out who's in the right. So if appeals, if you do not reach an agreement with appeals, what will happen is that is sent to tax court, and tax court's a different issue. We're not going to go into that, it's a little more complicated. But if you do reach an agreement with appeals, there's a couple different options of what could happen. First of all, you could be free from the situation. They could decide, okay, you're right, this is an error on the IRS, and maybe even you get a refund, and so you're out of that situation. The other possibility is that the appeals comes to an agreement, but that agreement is that, okay, you actually did have some income that you didn't report, and so here's a tax assessed. You have to pay some money into the IRS, and then we'll go into the collection process in a bit. Now, if you, going back to the proposed deficiency, if you do not protest that, you just kind of ignore it, whatever, then you get potentially a 90-day letter, in which scenario at that point you have the option of petitioning tax court. If you petition tax court, actually what happens is kind of the same process that we just went through. Appeals initially attempts to resolve the matter, and if appeals can't, then it's sent to tax court. If they can, then you have those other options that we just discussed. Now, if you do not petition tax court, again, you just kind of let that notice go by and you don't do anything about it, the tax is going to be assessed just based on the information that the IRS had, and what they proposed was the amount that you owe, whether or not it's correct. So no matter how you get to that point of the tax being assessed, then you move into the collection process of the IRS, which is one of their main functions. And then we have the notice of demand of payment within 60 days. followed by a series of requests for payment, potentially, and then you'd have a notice of lien. followed by a notice of levy that we're going to get into. Now, it's important to note at this point the difference between a lien and a levy. A lien is basically just the IRS stating that they have the right to take property in the payment of a debt that you have with them, and then the levy is the actual collection on that debt. So where they actually come and seize your property. And so if you do not respond to this notice of lien, then there's going to be a lien assessed on your account. Then you have the notice of intent to levy, and if you do not respond to that, then they will actually send you a final notice of levy, and that's a 30-day notice. This is the initial notice of intent to levy that you have some time to respond to. If you don't respond to those levy notices, then you will be assessed the levy, and the IRS will begin to collect. And there's a couple different ways that they can do that, a few different ways. First one is wage garnishment. That's probably the most common, and that's where they basically just take a certain percentage of your paycheck each time you receive a paycheck for your pay period. And they can do that indefinitely until they collect on the debt, or something changes, you present new information or whatever, which we're going to get into in a second. And then you have the bank account levy. That's more of a one-time levy where they just go into your account, maybe your savings account or something, and just take what's in there, or a certain portion of what's in there, up to the amount that you owe. And although it's a one-time levy, they can actually reinstate that levy and then come back and do it multiple times. Then you have the asset seizure, and that is less common. That's where they can actually take assets like an automobile or something like that and sell it in the payment of the debt you owe. Now, at any time during this whole collection process, some people think that they don't have any options, that they just have to pay the amount that they owe, and that's not necessarily the case. Even if you didn't respond to the earlier notices during the audit and the case is closed, right? And the IRS is saying you owe this money and we're going to levy you, all that kind of stuff. If they have incorrect information, there's still something you can do. It's called an audit reconsideration. And one of the easiest ways to do an audit reconsideration, to trigger an audit reconsideration, is just filing a Form 1040X amended return. And what that basically does is it presents new information. It's saying, okay, this is the way that the return was filed. There was a mistake. It was incomplete, and here's some additional information on that. This is basically this is the first page of the 1040X, just to give you an idea of what it is and what it's for. And so you can see on here you have the original amount that was reported on the return, or the amount that the IRS has on their records based on the adjustments they've made. Then you have the net change and then the correct amount. And then you have also an explanation of changes on the 1040X and any other forms that were changed in the process of coming to those numbers. Such, for example, if you get an underreporting notice and you didn't report some 1099 miscellaneous income, some non-employee compensation, for example, that's considered self-employment income usually. And so the IRS could say, hey, you didn't report this on your taxes, we're going to be putting it on your taxes. And since you didn't report it, you didn't report any expenses either, and so they're going to take the full amount as profit, and then they're going to charge you self-employment tax, and it's going to be pretty steep sometimes. So you could say, hey, actually I did receive that income, I didn't report it for whatever reason, I'm reporting it now, but I've also got these expenses that I do qualify for, maybe some mileage or phone expenses, whatever, and that's why you do the 1040X, to present that new information to them. After that's done, if you still owe money, or if you do not do that, there's still other options that you have at this point in the collection process, and those are some payment options that you have. So the three payment options we're going to be talking about is Installment Agreement, Offer and Compromise OIC, and Currently Not Collectible Status CNC. Installment Agreement is probably the most common way of dealing with the debt with the IRS, and what it is, it's just a monthly payment plan. And so it can be up to 72 months, 6 years. And so basically you can take the full amount that you owe from multiple years even, divided by 72, and you could potentially be paying that amount per month. And one thing to take into account when you're thinking about doing an installment agreement is that they charge you an initial fee to start the installment agreement. It's either $52 or $105. It's $105 if you just do it basically like, okay, I'm going to be paying, it's an agreement, I'm going to be paying this much by this day, maybe the 10th day of each month or whatever. And I'm going to be doing that on my own, paying it at the local IRS office, mailing it in online, something like that. They charge you $52 if you do an automatic withdrawal from your account, like your checking account. And so they kind of incentivize that because, I mean, they're more likely to get their money if they have it automatically withdrawn from your account. Then you have the Installment Agreement Request 9465, just so you can see it. It's a really easy form to fill out, pretty basic. Then we have Offer and Compromise. Offer and Compromise is talked about a lot. A lot of people attempt to do this, and because it's so novel. I mean, there's just this idea that you can get pennies, resolve your issue, settle your debt for pennies on the dollar, right, with the IRS. And then it's true. Sometimes people owe hundreds of thousands of dollars and they end up owing just a couple thousand. But it's you have to qualify for it, and you have to meet certain requirements. And so basically, in a nutshell, you have to have a hardship situation, which is where your income is at or below or somewhere around your necessary living expenses, and so you really can't pay much more. They also look at your potential to earn, like if you got laid off but you have a lot of experience and you're still pretty young, for example, you could maybe get a job later on, a really good high-paying job like you had before, and so they're not going to be likely to reduce your amount if they can reasonably think they're going to collect the full amount within 10 years. And that's what they have. They have 10 years to collect a debt from the date that it was assessed. It's called statute of limitations. Now then you have to calculate the offer, and that's with the 433 OIC form. And they take into account your assets and your income and everything. You have to calculate an offer that way. And then also it takes 6 months at least, usually, for the IRS to process the OIC. So it's kind of a long process. Sometimes it takes a year or longer for the IRS to get through that, partially because there's so many requests for OIC. And this is just the first page of the 433 OIC, the form that you have to fill out, just to give you an idea. Then we have currently not collectible status, CNC. This is the one that a lot of people don't know about. And basically what it is that you are in a hardship situation again, like with the OIC, you have to be in that. And you're saying, I can't reasonably pay anything at this time. Like my income, my necessary living expenses are the same, or my necessary living expenses are more than what I can handle. And if that's legitimate, then the IRS isn't going to collect on you. What's important to note on this is that it can change, right? First of all, there's statute of limitations. After 10 years, like I mentioned, those debts will drop off. So you could potentially be on currently not collectible status, like if you're in your 70s, you're just getting Social Security, something like that. Your situation is not going to change. You're not going to earn more money. You're not going to get a new job. You could be on CNC until that debt just drops off. But it's something to keep in account. Interest continues to accrue on that amount that you owe when you're on currently not collectible status. And then if you get a new job or something like that, your situation changes, IRS could start collecting again. And these are just some of the pages that you have for the 433 that you have to fill out a collection information statement to show that you should qualify for CNC. There's actually a shorter form called 433F. But anyway, so those are some of the payment options. So that's basically it. That's just a really brief overview of the examination and collection process with the IRS. And just want to plug in here for Low Income Taxpayer Clinic and the Taxpayer Advocate Service. These are free services that are available to the community. And the Low Income Taxpayer Clinic, as I mentioned briefly at the beginning, I work for Low Income Taxpayer Clinic in Utah, and this is designed to help people with their tax controversies with the IRS. And you have to qualify. You have to be under 250% of the poverty level, and your liability for any given year can't exceed $50,000. But we can help you with any stage of that process, helping you let you know what the notices mean, responding to them, doing amended returns, installment agreements, things like that. Then we have the Taxpayer Advocate Service, which is another great service. This is kind of a second stitch effort. You'd usually want to go to Low Income Taxpayer Clinic because they can resolve the majority of the issues. Taxpayer Advocate Service is designed for when the IRS is not being responsive. They're not doing their end. They're not following through, not being timely, things like that. And sometimes we in Low Income Taxpayer Clinic work with them to kind of push things through the IRS. And then it has to be causing you financial difficulties and facing immediate threat. So that's just kind of briefly what Taxpayer Advocate is. When you talk about Taxpayer Advocate Service, you have to also mention the National Taxpayer Advocate, and that is Nina Olson. She's amazing. We all love her, and apparently Neil Patrick Harris does too. So that's the free help, and that's that's this video. Hopefully we'll be doing some more videos in the future with more specifics about the collection process and the examination process, but this is just kind of, in a nutshell, a basic overview. Thanks for watching.